Okay, picture this for a second. What if your stocks, your bonds, heck, even a slice of a skyscraper could be traded in a flash, 24/7, anywhere in the world? Now that's not some sci-fi fantasy. It's the whole promise behind tokenized real-world assets, or RWAs. And today, we're going to map out the entire institutional-grade ecosystem that's making this multi-trillion-dollar revolution a reality, right now. All right, let's talk numbers because honestly, they tell the whole story. As of early 2026, we're looking at over $25 billion of real-world assets that have been brought onto public blockchains. Now, just to put that in perspective, that's up from only a few billion just a couple years ago. So this isn't just some passing trend, it's a massive, seismic shift. The big institutional money is on the move, and believe me, it is moving fast.
But here's the thing, it's about so much more than just digital ownership. This quote really nails it. We're talking about a fundamental upgrade to what an asset can do. I mean, think about it. A tokenized US Treasury bond, it can automatically pay you interest every single day. Shoot, every single minute with no bank in the middle. It stops being a passive entry on a ledger and becomes an active, intelligent piece of capital working for you 24/7.
And that brings us to really the single most important question in this whole transition. How in the world do you build a system that can move trillions of dollars from the old world of handshakes and paper contracts over to the new world of automated, code-driven blockchains, and do it without breaking trust? How do you guarantee not a single dollar gets lost in translation? Well, the entire RWA ecosystem is basically an engineering marvel designed to answer that one huge question. All right, so here's our game plan for today. First, we're going to look at the ironclad legal stuff that protects these assets in the real world. Then we'll jump into the tech that actually bridges them to the blockchain. After that, we'll meet the major players, the titans driving this whole thing, and we'll do a deep dive into the products they're building. And finally, we'll zoom way out and look at the big picture, where this is all going. Okay, let's dive right in. How do we solve that massive trust problem we talked about? Well, funny enough, it doesn't start with code, it starts with law. Before a single token ever gets minted, you have to build this absolutely bulletproof legal foundation in the real world. This is what we call the off-chain bedrock of the entire system. You know, this entire RWA architecture is really just an elegant solution to two huge problems. First up, you've got custody risk. In plain English, are the assets really there? And are they legally safe even if the company that issued the token goes bust? Then you have the oracle problem. How does a token on the blockchain get an accurate, real-time feed of what's happening with the asset in the real world? Let's tackle that first one, custody risk. So the main weapon in the legal arsenal here is something called a special purpose vehicle, or SPV. Now, the best way to think of it is like a legal fortress. It's a completely separate company set up for one reason and one reason only, to hold the assets. And here's the magic trick. It has this feature called bankruptcy remoteness. What that means is, even if the company that created the token, let's say an Ondo Finance, goes under, their creditors can't touch the assets inside that SPV fortress. They are totally legally walled off. And that's really the whole point, right? The SPV creates a legally enforceable firewall around the collateral. It's the thing that lets big institutional investors sleep at night, knowing that the US Treasuries backing their tokens are safe and sound, totally protected from outside drama.
Okay, so the assets are legally locked down off-chain. Great, but how does the blockchain know that, right? How can a piece of code verify a bunch of legal documents? Well, that's where the on-chain trust bridge comes into play. This is the tech side of the equation, and it's all about solving that famous oracle problem.
Just think of a blockchain as this perfectly secure but totally sealed room. It knows everything that happens inside its own walls with absolute certainty. But it has no windows. It can't see the outside world. It has no idea what a bank balance is or a stock price or how many gold bars are sitting in a vault. And that creates a massive risk. This idea that the on-chain token could decouple. Basically, that its connection to the real-world asset could break.
And this is the genius solution, a system called proof of reserve. You can basically think of it as an automated digital auditor that never sleeps. So here's how it works. A trusted custodian, someone like Anchorage or Zodia, provides a secure read-only data feed of the assets in the SPV. Then an oracle network, Chainlink is the big one here, acts like a super secure messenger. It constantly pings that data feed and reports the balance on-chain. And then the token smart contract has one simple, unbreakable rule. You cannot mint new tokens unless the oracle says the reserves are there to back them up. Simple as that.
And right there, that's the whole picture. You've got these two pillars of trust working together in perfect harmony. You use law to solve the custody risk with SPVs, and you use code to solve the data problem with oracles. Law and code. Together, they create this incredibly robust, verifiable bridge between the old financial world and the new.
Okay, so we've laid out the legal and the technical architecture. But who are the actual companies building all this stuff and using it? Well, to really get a handle on the market, you got to understand the 4 key roles. Let's meet the 4 titans of the RWA ecosystem. You know, they say it takes a village, and that's definitely true for tokenizing an asset. You've got the issuers, the ones creating the actual product. Then you have the oracles, the secure data messengers we just talked about. Third are the custodians, the folks who actually safeguard the real-world assets. And finally, of course, you have the users, the people and institutions putting all this to work. So let's start with the issuers. These guys are the architects of this whole new market. You've got the absolute titans of traditional finance like BlackRock and Franklin Templeton bringing their huge regulated funds on-chain. Then you have the DeFi native leaders, companies like Ondo Finance who are just laser-focused on tokenizing US treasuries. And then you have innovators like Centrifuge who are doing some really cool stuff, tokenizing more complex things like private credit by slicing it up into different risk levels.
So who's actually buying this stuff? Well, the demand really boils down to 2 main groups. First, you have institutional treasuries. These are crypto firms, but also, more and more, traditional companies. For them, it's simple. They want to earn a stable, low-risk yield on their cash, but they want to do it with the speed and transparency you only get on-chain. Then, on the other side, you have your DeFi whales. These are the sophisticated crypto natives who look at a tokenized treasury and see the ultimate form of pristine collateral. I mean, it's the safest asset on planet Earth, and now they can use it to borrow and lend in DeFi.
But it's super important to know that not all of these tokenized assets are built the same. The way they're designed under the hood actually has a huge impact on how useful they are, especially in the world of DeFi. So let's pop the hood and take a look at the anatomy of a tokenized treasury.
Okay, so how you actually get paid your interest? It might sound like a tiny detail, but trust me, it is absolutely critical for how easy these things are to use. There are basically 3 flavors. First, you have accruing tokens. This is the simplest and most DeFi-friendly way. The price of the token just goes up over time to reflect the yield. Super easy. Then there's rebasing tokens. Here, the price always stays at $1, but the number of tokens in your wallet magically increases. A little trickier. And finally, you have distribution models, which are like old-school stocks. You get a separate dividend payment that you have to go and claim. That first one, accruing, is really considered the gold standard. And this comparison here just shows you how specific this market is getting. You take BlackRock's BUIDL. It's a tokenized share of a fund, it's got a high minimum investment, and it's aimed right at qualified US investors. And it uses that super clean accruing yield model we just talked about. Now compare that to Ondo's USDY. That's structured as a tokenized note, and it's built from the ground up for non-US investors. So you see they're using totally different legal structures and yield models, all to hit different target audiences and deal with different regulations, even though at the end of the day they're both backed by super safe US government debt.
Now, of course, no system is perfect. There are definitely risks to be aware of. You always have smart contract risk. A bug in the code is always a possibility. You still have custody and oracle risk. At some level, you're still trusting those off-chain partners and their data feeds. And of course, there's regulatory risk, which is a big one, as the rules of the road are still being written all over the world. So while this whole architecture is designed to minimize these risks as much as humanly possible, it's so important to remember that nothing is ever completely risk-free.
So, what's the end game here? Where is all of this going? Well, building a bridge between the old and new financial systems, that's really just step 1. The ultimate vision, the big dream, isn't about connecting 2 separate worlds. It's about merging them into one.
This is the huge idea that people are starting to call the Finternet, a true financial internet. It's this concept of a unified ledger. Imagine a single global platform where stocks, bonds, currencies, real estate, everything, they all exist together as these smart, programmable tokens that can all talk to each other. So instead of having thousands of separate databases that can't communicate, you'd have one single shared source of truth for all the value in the world.
And this quote really captures just the breathtaking scale of what we're talking about. It's about taking literally every asset in the world and making it instantly transferable, easily divisible, and fully programmable. It's about building an entirely new foundation for the global economy, one with almost zero friction and open to everyone.
And look, this isn't some far-off, futuristic dream. The RWA ecosystem we've just walked through, the legal fortresses, the oracle messengers, the institutional-grade products,
That is the foundation. It's being laid brick by painstaking brick right now. The Great Migration has already started. And that leaves us with one final, really provocative question to think about. When this foundation is finally complete, what new financial world are we going to build on top of it?